Money is not real. Not in the way a rock is real, or a river, or a person. A banknote is a piece of cotton and linen worth almost nothing. It has value only because enough people simultaneously believe that it does, and that belief can dissolve. It has dissolved, repeatedly, destroying life savings overnight and toppling governments. And yet money is also the most powerful coordinating mechanism humanity has ever invented, the thing that makes civilization at scale possible. Here are 16 facts about money that will change how you think about the numbers in your bank account. Money is a shared fiction. Money is a collective hallucination. Money has no intrinsic value. A dollar bill is worth about 2 cents in materials. A Bitcoin is a string of numbers on a server. A pound coin is a disc of metal alloys worth a few pence in raw materials. Their value exists entirely in the shared belief of the people using them. This is not a flaw in money, it is the feature. Money works precisely because it is an abstraction, a universally accepted placeholder for value, that allows a baker to trade with a builder, without the builder needing bread right now. The earliest known money, clay tablets recording grain deposits in Sumerian temples around 3000 BC, was not coins or notes but records of debt, backed by a shared agreement that the grain existed, and the claim was legitimate. Every subsequent form of money, from gold coins to digital bank balances, works on the same principle. Gold seemed to escape this because it had intrinsic physical properties: beauty, rarity, indestructibility. But gold's monetary value was also a social agreement. Gold has very limited practical uses. The moment a community stopped accepting gold as payment, it became heavy, yellow metal. Money is the most successful shared fiction humanity has ever constructed, and its power comes entirely from the fact that we all agree to believe in it simultaneously. Debt is older than money. Debt existed before coins. The standard story of money is that humans started with barter, then invented money to make trade easier. Anthropological research, most notably by David Graeber in his 2011 book Debt, The First 5,000 Years, suggests this is largely myth. There is almost no evidence that any society operated primarily on barter as a daily economic system. Instead, the earliest economic records we have, Sumerian clay tablets from around 3000 BC, show sophisticated credit systems, records of debts, obligations, interest calculations, and accounts. People traded on credit, tracked obligations in community ledgers, and settled accounts periodically. The concept of owing something, of a social obligation that could be quantified and recorded, preceded the invention of physical money by centuries or millennia. Coins were invented later, often for specific purposes, paying soldiers, collecting taxes, or making large transactions where carrying credit records was impractical. The implication is profound. The economy did not evolve from barter to money. It evolved from trust-based community credit networks to impersonal monetary systems that could function between strangers. Money is not a replacement for barter. It is a replacement for trust. Cowrie shells and salt were global currencies. Strange things have been money. Throughout history, almost anything has functioned as money in different cultures, provided it was scarce, durable, divisible, and widely accepted. Cowrie shells, small, smooth, highly recognizable marine shells, were used as currency across China, India, Africa, and the Americas for thousands of years. The Chinese character for money, bei, is derived from the pictograph of a cowrie shell. Salt was so valuable as a currency and commodity in the ancient world that the word salary derives from the Latin salarium, possibly related to payments made to Roman soldiers in salt. Rye stones on the island of Yap, enormous limestone discs up to 4 meters in diameter, quarried in Palau and transported by canoe, functioned as currency not through physical transfer but through oral tradition. The ownership of a stone changed hands through public declaration, even if the stone stayed in the same place, even if it was at the bottom of the ocean. The Yap Islanders accepted that a stone lost at sea during transport still had value. Its existence and ownership were a matter of social record, not physical possession. The concept of money as a record of ownership rather than a physical object did not originate with digital banking. It originated on a Pacific island. Centuries ago, the first banks were in medieval Italy. The first modern banks were Italian. The word bank comes from the Italian banca, meaning the bench or counter on which medieval Italian moneylenders conducted business in the market. The first modern banking institutions offering deposit accounts, loans, currency exchange, and letters of credit emerged in the Italian city-states of the 13th and 14th centuries: Florence, Venice, Genoa, and Siena. The Bardi and Peruzzi banking families of Florence were financing the English crown's wars in the 14th century, and when Edward III of England defaulted on his loans in the 1340s, the Bardi and Peruzzi banks collapsed, triggering one of the first major international banking crises in history. The Medici family built their political power on the foundations of their banking business, which operated branches across Europe, and developed the letter of credit, an early forerunner of the modern check, to allow merchants to transfer funds across long distances without carrying gold. The banking techniques developed in medieval Italy, double-entry bookkeeping, letters of credit, risk management, fractional reserve lending, are the direct ancestors of every financial institution operating today. Modern banking was invented in the Italian Renaissance and has been causing crises ever since. Fractional reserve banks lend money they don't have. When you deposit money in a bank, the bank does not store your money in a vault waiting for you to collect it. It lends most of it out to other customers. Under fractional reserve banking, the system used by virtually every commercial bank in the world, banks are required to keep only a fraction of deposits as reserves and may lend the rest. If the reserve requirement is 10%, a bank receiving a £1,000 deposit may lend £900 of it. That £900, when deposited in another bank, can generate another £810 in loans. The process continues, with each loan generating new deposits and further lending, until the original £1,000 deposit has theoretically generated £10,000 in loans across the banking system. Money is literally created by the act of lending. When a bank makes a loan, it does not transfer existing money from a vault. It creates a new deposit in the borrower's account, new money that did not previously exist. The Bank of England has confirmed this explicitly in published research papers. Commercial banks in the UK create approximately 97% of the money in circulation through lending. Governments do not create most of the money in the economy. Private banks do, every time they approve a loan. The Nixon Shock and the end of the gold standard. Nixon abolished the gold standard in 1971. From 1944 to 1971, the global monetary system operated under the Bretton Woods Agreement. All major currencies were pegged to the US dollar, and the US dollar was convertible to gold at $35 per ounce. This meant every dollar in circulation was, in theory, backed by physical gold held at Fort Knox. On August 15, 1971, President Nixon appeared on television and announced that the United States was suspending the convertibility of dollars to gold, effectively ending the gold standard overnight, without international consultation, without a formal treaty revision. This event, called the Nixon Shock, transformed the global monetary system into what we have today: fiat currency, backed by nothing except government declaration and collective trust. The dollar is the world's reserve currency, the currency in which oil is priced. International debts are denominated, and foreign exchange reserves are held, backed by nothing except the faith that the United States government will continue to exist and honor its obligations. Every currency in the world is now fiat currency. The global financial system rests on trust in governments, nothing more. And the last physical anchor to that trust was removed on a Sunday evening in 1971, hyperinflation, when money becomes worthless. The Weimar Republic in Germany experienced one of history's most severe hyperinflations between 1921 and 1923. At its peak in November 1923, prices were doubling every 3.7 days. A loaf of bread that cost 250 marks in January 1923 cost 200 billion marks by November. Workers were paid twice daily so they could buy food before prices rose again at lunch. People famously used banknotes as wallpaper because the paper was worth more as an insulator than as currency. The hyperinflation was caused by a combination of the reparations burden from the Treaty of Versailles, government printing of money to fund spending, and a loss of confidence that became self-fulfilling. Zimbabwe's hyperinflation between 2007 and 2009 was even more extreme. At its peak, the monthly inflation rate was estimated at 79.6 billion%. The central bank issued $100 trillion notes that were worth less than the paper they were printed on within days of issue. Hyperinflation is not merely an economic problem. It is a social catastrophe. It destroys savings, eliminates the middle class, collapses trust in institutions, and creates political conditions in which extremism can take hold. The Weimar hyperinflation directly contributed to the political conditions that enabled Hitler's rise to power. The Dutch tulip mania, the first asset bubble. In the 1630s, the Netherlands experienced the first well-documented speculative asset bubble. Tulips, recently introduced from the Ottoman Empire and prized for their vivid, unusual colors, became objects of intense speculation. Tulip bulbs, particularly rare color variants caused by a mosaic virus, reached extraordinary prices. At the peak of the mania, in February 1637, a single bulb of the Semper Augustus variety reportedly sold for as much as 10,000 guilders, roughly the cost of a substantial house on an Amsterdam canal. Futures contracts for bulbs not yet grown were traded in taverns. People sold property and livestock to speculate. Then, suddenly, in February 1637, buyers failed to show up at a routine auction and prices collapsed. The bubble burst in days. The precise causes and scale of the mania have been debated by historians, with some arguing the crash was less catastrophic than the legend suggests. Most actual contracts were renegotiated rather than enforced. But the pattern that tulip mania established, novel asset, speculative frenzy, price disconnection from underlying value, sudden crash, recrimination, has been repeated in every financial bubble since. From South Sea Company shares in 1720, to mortgage-backed securities in 2008, to various cryptocurrencies in the 21st century. The 2008 financial crisis and credit default swaps the 2008 crash. How banks bet against their own products. The 2008 global financial crisis had many causes, but at its center was a product so complex that the people selling it often did not understand it. Mortgage-backed securities bundled thousands of individual home loans into tradable bonds. Rating agencies rated many of these bonds as highly safe, based on models that assumed house prices would not fall simultaneously across the entire country. When the U.S. housing market began to decline and subprime mortgage holders defaulted, the bonds collapsed in value. Banks that held large quantities of these securities faced catastrophic losses. The additional instrument that amplified the crisis was the credit default swap, a contract that functioned like insurance against a bond defaulting, but could be bought by anyone, not just the bond owner. This meant banks and hedge funds could effectively bet that the bonds would fail, and some did, borrowing toxic assets, insuring them heavily, and collecting when they collapsed. When AIG, the insurance giant that had sold enormous quantities of credit default swaps, faced collapse in September 2008, the U.S. government bailed it out with $85 billion of public money to prevent a cascade of failures throughout the global financial system. The instruments that caused the crisis had been legal, widely traded, and rated as safe almost until the moment they destroyed trillions of dollars of wealth. Compound interest, the most powerful force in finance. Compound interest is the process by which interest is calculated, not just on the original principal, but also on the accumulated interest from prior periods. It is simple arithmetic that produces results that appear magical. If you invest $1,000 at 7% annual interest and reinvest all returns, you will have approximately $2,000 after 10 years, $7,600 after 30 years, $29,500 after 50 years, and $114,000 after 70 years. The original investment grows 114-fold, not because of any clever strategy, but because interest compounds on interest, year after year. The same principle works in reverse for debt. A credit card charging 20% annual interest will double the outstanding balance in approximately 3.6 years if no payments are made, by which point the debt is on interest charged on interest charged on interest. Albert Einstein is frequently but probably falsely credited with calling compound interest the eighth wonder of the world. But whoever said it was identifying something real. Compound interest is the mechanism by which patient wealth accumulates and impatient debt spirals. Warren Buffett made approximately 99% of his wealth after the age of 52, not through superior investment skill in old age, but through the compounding of decades of earlier returns. Time is the engine. The rest is patience. The Federal Reserve is not fully federal. The Federal Reserve is a strange institution. The Federal Reserve, the central bank of the United States, arguably the most powerful financial institution on earth, is not a government agency. It is a hybrid entity. The Board of Governors is a government agency, but the 12 regional Federal Reserve banks are private corporations, owned by member commercial banks in their districts. The Fed was created in 1913 following a series of banking panics, most notably the Panic of 1907, which was resolved not by the government, but by the private intervention of J.P. Morgan, who coordinated a group of bankers to inject liquidity into the system. The experience demonstrated that the U.S. economy needed a lender of last resort, an institution that could create money in a crisis to prevent bank runs from cascading into economic collapse. The Fed sets the benchmark interest rate that influences borrowing costs throughout the entire global economy. When the Fed raises rates, mortgage payments increase across America, corporate borrowing costs rise worldwide, and currencies in developing countries that have borrowed in dollars come under pressure. The decisions of 12 people in Washington have direct material consequences for billions of people in every country on Earth. And those 12 people are appointed through a process combining presidential nomination, Senate confirmation, and private banking sector input. Money and the brain. Money changes how your brain works. The psychological effects of money and its absence on human cognition are well documented and deeply counterintuitive. Merely thinking about money, studies have shown, makes people more self-reliant, less socially connected, less helpful to strangers, and less likely to ask for or offer assistance. In one famous experiment, participants who had played a game involving money were less likely to help a researcher who dropped pencils than those who had played a game involving neutral objects. The effect appeared even when participants were simply shown images of money. Scarcity, particularly financial scarcity, consumes cognitive bandwidth. Research by Sendhil Mullainathan and Eldar Shafir found that people experiencing financial stress perform measurably worse on IQ tests and cognitive tasks, not because poverty selects for lower intelligence, but because the mental load of managing scarcity actively impairs cognitive function in the moment. The stress of not having enough money literally makes it harder to think clearly, which helps explain why financial decisions made under poverty are sometimes poor, and why poverty has a cognitive as well as a material dimension. Money is not just an economic phenomenon. It is a psychological environment that shapes behavior, cognition, and social relationships in ways that people are largely unaware of. Quantitative easing, creating money from nothing. Quantitative easing, QE, is a monetary policy tool used by central banks in which the bank creates new money electronically and uses it to purchase financial assets, usually government bonds, from the open market. The process does not involve printing physical notes. The central bank simply credits the accounts of the banks selling the bonds with newly created reserves. This increases the total money supply and injects liquidity into the financial system. The Bank of England used QE extensively after the 2008 financial crisis and again during the COVID-19 pandemic, creating over £895 billion in this way. The U.S. Federal Reserve's balance sheet expanded from approximately $900 billion before 2008 to over $9 trillion at its peak in 2022 through QE programs. Critics argue that QE primarily inflates asset prices, stocks, bonds, property, benefiting those who already own assets while doing little for those who don't, thereby increasing wealth inequality. Proponents argue it prevented deflation and economic collapse in moments of crisis. The long-term consequences of the extraordinary expansion of central bank balance sheets since 2008 remain genuinely uncertain. No previous generation of economists has navigated this experiment, because no central bank has ever done this at this scale before. Bitcoin and the invention of digital scarcity. Bitcoin, the first scarce digital object. Before Bitcoin, there was no such thing as a scarce digital object. Every digital file can be copied perfectly and infinitely, at zero cost. This made digital cash impossible. Any digital currency could simply be copied and spent multiple times. In 2008, An anonymous person or group using the name Satoshi Nakamoto published a paper describing a solution, a distributed ledger, the blockchain, maintained by a network of computers, each holding a complete copy, in which every transaction is cryptographically verified and recorded permanently. No central authority controls it. New Bitcoin is created through a process called mining, solving computational puzzles, but the total supply is capped at 21 million coins by the protocol's design. This hard cap creates digital scarcity for the first time in history. Whether Bitcoin is a currency, a commodity, a speculative asset, or a store of value like digital gold is genuinely contested. It has been declared dead hundreds of times, and has risen to over $100,000 per coin. It uses more electricity than many countries. Its inventor has never been identified. Thousands of imitative cryptocurrencies have been created, most of which have failed. Bitcoin is either one of the most important financial innovations in history, or the largest speculative bubble ever constructed. Possibly both. The end of cash, the death of physical money. Physical cash, coins and notes, is disappearing. In Sweden, less than 10% of transactions are now made with cash, and many businesses and banks no longer accept it. In the UK, cash use halved between 2015 and 2020. In China, mobile payment systems WeChat Pay and Alipay handle the vast majority of retail transactions. The COVID-19 pandemic accelerated the shift. Concerns about physical transmission on notes and coins, combined with the expansion of contactless payment systems, dramatically reduced cash use across most developed economies. Central banks worldwide are developing central bank digital currencies, CBDCs, state-issued digital currencies that would allow governments to track every transaction, implement monetary policy at the individual level, and potentially eliminate financial crime. Critics raise profound privacy concerns. A CBDC gives governments the technical ability to monitor all spending, restrict certain purchases, impose expiry dates on money, and exclude individuals from the financial system entirely. The transition from physical to digital money is the most significant change to the nature of money since the invention of banknotes, and it is happening now, with most people not paying attention to what it means. The wealth gap and its mathematics, the mathematics of wealth concentration. In 2023, the world's 8 richest people held more wealth than the bottom half of the global population combined, roughly 4 billion people. This extreme concentration is not primarily the result of those individuals working harder or being cleverer than billions of others. It is largely the result of compound returns on capital. Money, invested, generates returns. Those returns, reinvested, generate further returns. Wealth begets wealth at an exponential rate. Economist Thomas Piketty, in his 2013 book Capital in the 21st Century, documented that, across most of recorded history, the return on capital, typically 4 to 5% annually, exceeds economic growth rates of 1 to 2%. When capital returns exceed growth, wealth concentrates relentlessly toward those who already have it. The only historical periods in which this trend reversed, when inequality fell, were the 2 world wars, which physically destroyed capital, and the progressive taxation regimes of the mid-20th century, which redistributed returns. The mathematics of compound returns on capital are, in the absence of redistribution mechanisms, an engine of concentration. The extreme wealth inequality of the early 21st century is not an accident or an anomaly. It is the expected mathematical outcome of allowing capital returns to compound freely across generations. Thank you for watching. Money is the medium through which human civilization coordinates, competes, and survives, and it is built on a foundation of collective belief that is more fragile than most people realize. The numbers in your bank account are not a record of physical objects stored somewhere. They are a promise, maintained by institutions, backed by faith, and dependent on everyone agreeing to keep the game going. So far, we always have. Subscribe for more, and we will see you in the next video.